the more open an economy is, the less likely it is that fiscal policy is going to be effective. Now recall that fiscal policy happens when the government changes taxes and when the government changes government spending in order to influence aggregate demand. So let's assume that we have an economy in full employment. And then we're going to see what happens to that economy in response to an aggregate demand slump. Well, we know when we have an aggregate demand slump that this is going to lead to lower economic growth and lower inflation. Suppose that nominal spending quits growing at all, leading to an inflation rate of 1% and an economic growth rate of negative 1%. Now we want to see what happens if the government steps in and tries to fix this using fiscal policy. So what they want to do is increase the budget deficit. In order to increase the budget deficit, they're going to have to cover the difference between what they're bringing in and what they're spending by borrowing. And by borrowing, they might actually increase the interest rate. So let's go to the market for loanable funds. The government steps in and they decide that they wish to borrow money. They're going to enter on the demand side of the market. So there's an increase in government spending or a cut in taxes, something that's going to have to be financed with an increase in the budget deficit. Maybe we get more saving. But we reduce private investment. Meaning that some private investment gets crowded out, and this change in government spending gets financed with the deficit. And the government's having to borrow now, which raises interest rates. So there's a crowding out effect that's discussed in chapters 17 and 18 of Cowan and Tabarrok, but there's going to be a second effect that's also important in light of what we've learned in chapter 20, and that second effect is the effect on exchange rates. If interest rates are higher in the United States, then foreigners are now going to want to buy American assets that are yielding American interest rates. Therefore, they're going to demand more dollars. So, we look at the market for dollars. Prices denominated in euros per dollar. Foreigners seeing higher interest rates in the United States are going to increase their demand for dollar-denominated assets. That's going to increase the exchange rate. That's going to make dollars more expensive abroad. And if dollars get more expensive abroad, foreigners are going to buy fewer American assets. So what this is going to do is depress exports. So we're going to have a second channel through which fiscal policy may not be as effective as we would like for it to be in an ideal case. First, fiscal policy might crowd out some of the private spending that takes place in the economy. Second, fiscal policy, as a result of an increase in the budget deficit, might raise interest rates, thereby raise the exchange rate and depress exports.